Welcome to the Utilization of Money podcast with Todd Levine from Levine Financial Group. In this podcast, we teach our clients how to own their personal economy. Join us on this journey where we build upon your greatest asset as Todd draws from his years of expertise, solutions, strategies, and expert guest stories to help you understand how money works.
Hello and welcome to Utilization of Money with the team from Levine Financial Group. Today, Micheal Karlin is in the hot seat. Micheal, how are you?
I am well, my friend. How are you?
I'm just going to sit back and listen to you talk because your voice is so smooth, man. I'm just telling you. That's just my opinion. That's Eric's opinion, but I think everybody's going to agree with me.
I guess I should have been Bob Barker. I probably would have liked that job a long time ago.
Oh, wouldn't that be fun to just give stuff away all the time? I mean, come on. I'd love to be able to do that. I'm not at that point in my life financially, but maybe you can help me with that.
Happily to do so.
All right. Well, Bob Barker and The Price is Right is not the focus of today's podcast, although that was a fantastic show. Today we're talking about college savings plans, right?
Yes, sir.
All right. And that's a huge topic. And especially right now, it's a very interesting one. I bet you'll have some pointers on this as well. But in this era of COVID, as I guess I'm calling it this moment, college looks a lot different. But I believe paying for college really hasn't changed a whole lot.
I believe that's a true unfortunate thing.
Yeah, I think they still want money. So how do we get that paid for without breaking the bank?
Yeah, well, it's actually I think it's probably one of the hottest topics, especially for anyone who's under the age of 35, where they're trying to help their child or help themselves with their child plan and schedule for college payments. I used to joke around that that's what separates the men from the boys, right? Because it's challenging, and if you're not really prepared and you have not really planned for that, when that time frame creeps up on you, it becomes a bit daunting and overwhelming.
Absolutely. The numbers that I've heard recently are just staggering, in the hundreds of thousands of dollars for an education, and that's scary.
It's amazing. I'm giggling because as a person knee deep in this process, it's really amazing. My daughter went for 4 years to a university on the western side of the United States, and my son goes to the New England area, and this will be his senior year starting in September. And it's kind of amazing, really, if you look at the overall basket of the expense, when it's virtually complete, it's really, really somewhat monstrous.
Yeah, absolutely. So what do we do about that?
So I think today the best thing to talk about are some of the venues and the vehicles in which you could use in order to prepare to save for college, and then discuss some of the differences, some of the benefits, and some of maybe the highlights as to where the money may be able to be best suited. So I really believe that everyone kind of knows that there are, for example, everyone knows there's a 401k or an idea like that when we talk about saving for retirement. Mm-hmm. And when we talk about saving for college, I'd say pretty much it's a broad base that people understand what a 529 is, and people understand what an UTMA or an UGMA are, and people understand basic savings, just putting away money. But there are actually one other huge option, and I think we'll get to that at some point, but I like the idea of at least starting by going over some of the thought process on why people choose some of the other venues to begin to save for college.
Yeah, no, that'd be great. And you said most people probably know about an UTMA or an UGMA. I'm not one of those people. So I'm looking forward to hearing.
How could you not be one of those people, for gosh sakes?
I know, but that's why I'm here. I'm here to be educated. Micheal, teach me.
Well, I hope I can, actually. So an UTMA is a uniform transfer to minor. So it's basically receiving gifts, right, from a donor, meaning a parent and or a grandparent and or whatever. And the uniform gift to minor, which is an UGMA, is the same basic idea where you can give and donate money, which sits in an account that actually starts to grow and starts to set forth money savings towards college. It's different than a 529, and I would love to be able to give you the options and the discussions of the different points. So a 529, or a typical 529, which is, I think every state has its own 529 plan. So that the money that goes into the 529 plan can only be used to qualify education expenses. You can't utilize the money in a 529 for any other concept than a qualified education expense. If in fact you do, then it becomes a taxable event with penalty.
Ooh.
So it kind of sits somewhat at that point in time like an IRA or a 401k if you take distributions before the age of 59 and a half. The idea of planning to save for those educations, the 529 allows you in every state to try to set forth whatever the rules are and whatever the few limited options are that you can put into certain baskets. Like, in other words, you're allowed to invest in 3 or 4 possible scenarios where the money can go. Maybe one may be a little more risky, maybe one may be a little less. It literally sits and looks on concept as a 401k, right? We can't invest in anything we want in a 401k. We can invest in whatever our plan offers us with a very few limited options. And the 529 is very much the same concept as that. The few issues, before I give you an issue with the 529, I just want to explain that the purpose of a 529, aside from making sure that we're using for college expense or any kind of educational expense, right? So the money is sitting in there growing tax-free, and if withdrawals are used for tuition or room and board or any qualified expense for education, then the money's not taxed in there either. So it's a wonderful place to put money if, in fact, you're looking to save for college. But there are some limitations, as we discussed, about where and what to do with the money and how it can be invested, and the adverse tax consequences should we actually want to utilize the money not for a college expense. The other few points that question about the 529 would be its limited access, right? Because we can only use it for those points. And then my argument always is it becomes an issue of sequence of returns risk.
Okay.
And I'm going to try to explain to you what that is. So to me, if you go to save for something for a long period of time, for example, retirement, and we actually are putting in a specific amount of money and allowing it to grow over time, when we go to retire, if the year that we choose to retire, or if 2 years before the time of college expense would actually become prudent, we actually have a market like this particular year. And let's say it doesn't recover for 3 or 4 years from that point forward, you reach a problem called sequence of returns risk. And what the risk there is that I've grown all this money until 2 or 3 years before I need it. And now the market has actually hurt me, and I don't know if I'm going to have recovery during the time in which I'm forced to take my withdrawals.
Yeah.
And that becomes a humongous problem should we actually have a bad environment right before or around the time of distribution. It's literally exactly the same problem with a 401k. You hear all the advisors say to you, well, you have plenty of time. You're not planning on retiring for 30, 40, however many years. But the problem with that thought process is that it's the same with this 529. You don't have a lot of time. You have a specific time. And when your specific time tries to reach its fruition, you can't have a negative sequence of returns, or you're going to have an issue.
Yep.
Right? If I'm going into college the year before I go or send my child to college, and let's just use a hypothetical example.
Sure.
College is $50,000 a year, and I have $179,000 going into the year before my child starts, and it was the beginning of 2020, and I lost 35% of my asset. What would happen when I started and being forced to take a distribution?
Yeah.
And that, I think, is a dangerous game of that sequence of return.
Mm-hmm. Michael, earlier you said that, if you don't use the plan for education, that there's penalties involved. So I'll give you a hypothetical since you just gave me one. Let's say, we all have plans for our children. We would all love the absolute best education for them, so on and so forth. But let's say our child decides to join a cult. The followers of a dandelion or something. I don't know. They just blow in the wind, right? They're just whatever. Herbivores and all that stuff. So they decide to join that instead of going to school. What can you do with the 529 plan at that point if they just absolutely refuse to, go to school? And what kind of penalties are we talking about?
Right. So I'm going to answer your question, and then I actually would like to give you an example on another side of the coin, which some people don't think of as well. Okay. And it's a great question because, Eric, here's where there's always an issue, right? So, for example, if I have a 529 for my eldest child who is 18, and I have a 529 plan for my younger child who is 15, and my 18-year-old says, I'm not going to college, I want to follow the dandelion cult, then the money that's sitting in the 529 has a few options. The first option would be is I could give it to my other child. But at that point in time, now my child has two 529 plans. And if, in fact, more than enough money needed for college, then I run into an issue where I would have a tax consequence because what else would I do with it unless I sit around and wait until we can donate it to a grandchild? So that becomes just a pile of money that's literally, we love the term locked out of your wealth. And not so much in a 529, but we question if we put monies into vehicles that you can't ever get to, aside from the set reason that it's used for, what actually is the asset worth if you can't touch it? And so the answer to the 529 question that you asked is yes, of course, you could donate it to or kind of give it to, I think they roll it into the opposite child. The consequence, of course, is if in fact you have plenty of money in them and they don't need it, what do we do? And I think the other alternative is if we try to use it for other than educational purposes, then we're going to have to pay taxes and penalties, right? That seems kind of, I'm going to say counterintuitive, but I wanted to use as an example the complete opposite side of the spectrum, okay? And I'm going to give you what we know as one of our clients has somewhat suffered through. Imagine having one child, so money in a 529 would either need to be used or what would you do with it? And imagine the fact that your child, after you've saved an inordinate amount of money into a 529 plan, your child decides which college they would like to go to, and they pick one, and the world comes back that they're so intellectual that they got a free ride scholarship.
Nice.
And then when they just about finishing their sophomore year and they declare a major, and they finalized a major and they finished the next 2 years with a specific venue in which to travel, they decide that they would like to be a doctor. And then you plan to go to medical school and, in fact, get another scholarship.
Well, good for them.
But you actually then have an inordinate pile of cash that you're pushing the age of 27, and the money must be moved by the age of 30 with nowhere else to put it. There's clearly no grandchild, as your child just graduated from medical school.
Yeah.
There's a pile's worth of money in this. And what actually could we do with this money? So I think there's a few issues with the 529, and that one example may be a little extreme on the one side, but amazingly enough, we actually legitimately have that as a viable problem from someone that we have as a client. And I believe that over the course of time, if you have other option problems, then you're leaving yourself exposed to too much in the way of an error, almost as if we were 55 years old and we took all the money out of our 401k and we had to pay the highest tax bracket, plus we had to pay penalty. And so with a 529, that's where I find some of the difficulties outside of sequence of returns risk, which I would like to go into again as we go to UTMA and UGMA scenarios for college savings.
Well, I was just going to ask, the UTMA and the UGMA, is that a better situation than the 529 then?
Well, again, I think the discussion always is there's real reason why people do everything, right? You may think that your state has a discount if you're doing a 529. You may think that, there's better benefits one side or the other. My argument always, and how we kind of rectify the situation, is this. We show you every venue and we educate our clients. There's nothing better than education. And there's no better reason that they would want to participate in whichever the venue is once they hear all the options. I think what happens is we always joke around about it as an opinion, and everyone's opinion does some degree make sense, but why don't we get all the facts and why don't we learn and take every day as a learning experience and make an educated decision before we just say, yep, 529 or yep, UGMA or whichever.
Yeah.
So if we're going to go for the education, I'll continue down in an UTMA-UGMA fashion and say, in this particular case, there's plenty of flexibility with the money because you're putting in money, or you can put in whatever amount of money you want, and you're putting it in where you're in charge of the money as the donor, until some really bizarre thing happens, which is that your kid turns 18 or 21, which is depending on the state. Because at that point in time, the child is now no longer a child, and they gain complete control of the money.
Oh, seriously?
Well, it's called a gift to the Minors Act, or a transfer to the minors, and they are no longer such. So I guess if there were a lot of people doing that, and I guess if we go back to my friend Eric's example and say that we want to join a cult, right? I might join the cult and I might be the person with the Volkswagen bus, or I might be the person with the Ferrari just for the sake of it.
Exactly. Oh, man.
So there is an issue with that because obviously the money can be used for non-educational purposes, because if you're utilizing the money, right, it was a gift. So the gift can necessarily be utilized however the parent deems accurate until we actually get to these age brackets.
Yeah.
And then, despite the fact that I don't think that your example and or mine would occur, you could never guarantee that. And because you couldn't guarantee it, I would have to show you and explain to you the same way I just did, is that at least unless we're going to write something down somewhere, that the money then would need to be placed somewhere different, then that's the problem with an UTMA.
Yeah. Wow.
Right. And then there's other issues with an UTMA, which is that there are fewer tax advantages than a 529. And part of the issue there is the first $1,100 of income, right, would be tax-free on a distribution, right? But the next $1,100 would be taxed at the child's rate, which I'm guessing would be the lower of the tax bracket rates. But all of the money earned above the $2,200 would be taxed at the rates for trusts and estates and or the guardians or the parent rate. So where there's more flexibility and where there's the option that you can use the money if you don't need it for educational purposes for other things, there are different tax disadvantages. And there is, to me, the big issue with the termination of the plan as the child reaches maturity or as an adult. And then one never knows what can happen. I believe I was once told, one never knows, does one?
Well, and here's the thing: is that I jokingly brought up the example of the cult of the dandelion followers or whoever they are, but here's the thing: is that even if they're going to college, what college student didn't like better things in their dorm or they're living wherever they're living? All of a sudden they're going to be getting that bigger TV that they didn't necessarily need, but boy, that really spoke to them when they were in Best Buy, right? Or
and those are problematic things. I mean, listen, what's the chances that can occur? I don't know, maybe low, but the fact is it's still open as a suggestion, and the fact is it has to be transferred.
Yeah. Yep. Absolutely.
And so with that, I tend to at least show my clients the idea that would be, even if to the minor extreme, certainly something that they would have to watch out for.
Yeah, definitely.
Right? I mean, just again, another venue for saving for college, but has its very positive benefits. It doesn't have to be for education. It could be, whatever, but also it has its negatives. And so like everything else, everything has a positive and negative, but I think the education piece, again, at least allows you to say, okay, well, I see where there would be an issue.
Yeah. So what's another option then?
So then that takes us to what we would call a third option, which is the purchase of a dividend-paying whole life insurance policy. And the point of that is it's a gift. We call it the gift of a lifetime. And the reason why, it's basically, for those of us who are a little bit older, I don't know if the younger people can remember, because I think it still exists, but I think it's very minimal at this point in time. But in the old days, there used to be something the second you had a child, and it was called a Gerber Life Plan. I don't know if you recall that.
Yeah. Yep.
But basically, the point of that was the second that you had a child, you were preparing to give them a lifetime gift. And the lifetime gift is the old Gerber lifetime gift, I'll go with, was basically a very, very plain Jane, no benefit anything above and beyond a very basic whole life insurance plan. Saving money, collecting money, going forward with money, making sure that you consistently save, kind of like an old Christmas club card, the way the banks used to offer that operation. And what dividend paying whole life insurance is basically, I mean, if I'm trying to be fair to it, I would say it was an old Gerber plan on steroids, right? Because the reason why is because the dividend paying whole life insurance, especially through a major mutual company, allows you on an annual basis to save money. It allows you on an annual basis to have growth. And it allows you on an annual basis to collect the dividend. And so the growth inside that plan would be way in excess or way excessive comparative to the old Gerber style plan. The reason why we would recommend such a discussion for this is that every time you would need money for the child, regardless of what it was for, you would actually get to utilize it for anything. And when I say anything, we joke around. You want to help them with their first car. You want to help them with college payments. You want to help them get their first house. You want planning for retirement. Whatever the case is, this goes along with them for the rest of their life, which is exactly why it's called a gift of a lifetime. Mm-hmm. And it actually continues to be a gift, self-completing plan, gift of a lifetime, to even the grandchild, because obviously, since it's a life insurance policy, it comes with a death benefit. So when we call it self-completing plan, it becomes a self-completing plan because it's there for every time you might need it, but it also is there with a death benefit when that person should become deceased.
Okay.
I think the one interesting thing, and I didn't really touch upon, and forgive me, and I'm not going to go regress, but the UTMA and the UGMA and the 529 plan have something called sequence of returns that we discussed. Mm-hmm. The UTMA has the same problem because dependent on where it is being invested in, it has that kind of risk. The dividend paying whole life insurance is an uncorrelated to the market asset. It's collecting a savings vehicle, so to speak, inside this plan. It's collecting those at regular payments, plus the dividends, plus the growth. And it doesn't matter if the market goes up or down as many points as you think is a good or bad scenario. No matter what, it actually continues to grow on an uncorrelated condition. And that's something that you really, in the world that we live in, avoids the sequence of returns risk. I think there are times where maybe, and we've talked to our clients about this, maybe hybrids in certain of these situations would be beneficial. But in this particular case, when you have something that's non-correlated to the market, you have really a huge bonus because virtually everything else is correlated to the market.
Yeah, absolutely.
Even buying a house or buying a car or buying something, because if the economy is good, the prices will be up. So I don't really recognize the benefit to only going in one direction, especially in respect of the first two, but I understand the importance of the non-correlated play, right? I think also in this particular case, right, you're avoiding the sequence of returns risk, but you're also possibly playing a game of coordination, which is just what I would explain to all of my clients who are looking to utilize certain vehicles to create a three-legged stool portfolio, or some way to look at things in an overall broad-based approach, rather than saying we need to do this only, or we need to do that, or you got to do a 529, you got to do a 401k, or you got to do this. Because what happens at this point in time is that let's say we utilize all three of these things. Let's just go back to my example from before. You utilize all three. You put in an UTMA, you put in a 529, and you put in this dividend-paying whole life insurance plan. The year before we go to college, the monies that are in the first two areas get kind of beat up a little because we used 2020 as an example. Well, then wouldn't it be great to know that we could take the first piece from the dividend paying whole life insurance, which was non-correlated to the market and did not go down, and allow the bounce and or the recovery of the market, if there should be such, without forcing that distribution on a low.
Yeah.
So once again, I'll give you my grandmother's favorite phrase, which was never put all your eggs in one basket. And certainly this is an ideal example of such.
Yeah, absolutely. Michael, I know we're running low on time. There's so much that you could cover in this, and I know that people will have questions, and this is exactly why I've said it time and time again, people need to be working with a financial professional for this exact reason. You can put things together in such a way that we just don't know what we don't know, right, as the general public. So first of all, I want to make sure that we give your contact information out there so they can reach out to you. But before that, I want to see, is there any closing thoughts for today's podcast?
Yeah, so the only thing that I will say as a closing thought is I was going to give another example, which I think shows you exactly how you can utilize everything in the world that is offered to you. But again, if you don't have education, it's hard to base your world on an opinion, especially in finance. Right? Just because my mother did it or my grandmother did it that way doesn't mean that that's correct. And just because everyone else is doing something, we don't have to all follow like sheep.
Yeah.
It's just not an intellectual way to look at things. If I have a leak, I call a plumber, right? If I need electrical work, I call an electrician. How everybody thinks it's easy to do the worst, most challenging thing, which is dealing with all of your finances and everything that will go on, twists and turns in your life forever. People think they can do that with the finances on their own. I think it's just a poor and foolish behavior.
Yeah, I agree 100%. Michael, again, great podcast. How do they get a hold of you if they want to start asking some of these questions and seeing how what you guys do would really fit into their lifelong plan?
Yeah. So listen, as always, we're here almost as often as I can believe that we are here. They can contact the office. Feel free to contact the office, 732-526-2922. Or they can certainly go on the website, ownyourpe.com. And by no means jump in there, and you can certainly see my ugly mug when you're looking, and you can email the office and or email myself and happily grab conversation. Again, I used to joke around, I have the most amazing open door to my office. Anybody who needs anything about anything can happily walk in here at any point in time. And I appreciate and look forward to being able to help anyone in any capacity.
Well, that's what we love about you, Michael. Thank you so much. You are very giving, and thank you for giving your time today.
No problem. It's always my pleasure. Thank you so much, Eric.
You bet. And the last thank you goes to you, the listening audience. Thank you for tuning in and listening to the Utilization of Money podcast with the team from Levine Financial Group. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And this is a great one to share because you probably have aunts, uncles, friends, family, grandparents that may want to contribute to your child's educational expenses. And boy, if they knew about these different things that they could be doing, it'd make it easier for everyone and safer for everyone, in my opinion. Again, thanks for listening today. For everyone at Levine Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Utilization of Money podcast. Click the subscribe button below to be notified when new episodes become available.
Micheal Karlin is a registered representative of Park Avenue Securities, LLC PAS. OSJ 1150 Raritan Road, Suite 201, Cranford, New Jersey 07016. Securities products offered through PAS, member of FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Levine Financial Group is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K13300. Guardian and its subsidiaries and agents and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Material discussed is meant for general informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. All investments contain risk and may lose value. Past performance is not a guarantee of future results.
Investing in 529 plans involves risk, including loss of principal. Before you invest in a 529 plan, request the plan's official statement and read it carefully. The official statement contains more complete information, including investment objectives, charges, expenses, and the risks of investing in a 529 plan, which you should carefully consider before investing. You should also consider whether your home state or your beneficiary's home state offers any state tax or other benefits that are only available for investments in such state's 529 plan. Section 529 plans are not guaranteed by any state or federal agency. By investing in a 529 plan outside of the state in which you pay taxes, you may lose the tax benefits offered by that state's plan. Withdrawals used for qualified expenses are federally tax-free. Tax treatment at the state level may vary. Whole life insurance is intended to provide death benefit protection for an individual's entire life. With payment of the required guarantee premiums, you will receive a guaranteed death benefit and guaranteed cash values inside the policy. Guarantees are based on the claims paying ability of the issuing insurance company. Dividends are not guaranteed and are declared annually by the issuing insurance company's board of directors. Any loans or withdrawals reduce the policy's death benefits and cash values and affect the policy's dividend and guarantees. Whole life insurance should be considered for its long-term value. Early cash value accumulation and early payment of dividends depend upon policy type and/or policy design, and cash value accumulation is offset by insurance and company expenses. Consult with your representative and refer to your whole life insurance illustration for more information about your particular whole life insurance policy. All whole life insurance policy guarantees are subject to the timely payment of all required premiums and the claims paying ability of the issuing insurance company. Policy loans and withdrawals affect the guarantees by reducing the policy's death benefit and cash values. Some whole life policies do not have cash values in the first 2 years of the policy and don't pay a dividend until the policy's 3rd year. Talk to your financial representative and refer to your individual whole life policy illustration for more information.